Domestic institution investors DII. Are they local institutions buying shares in India? Let's find out in this video. Domestic institution investors are institutional investors that invest in securities and assets of the country they are based in. DIIs are organizations such as banks, insurance companies, mutual funds, and so on. In India, domestic institutional investors have a big role when it comes to the growth and performance of the nation's stock market. This becomes very important, especially when foreign institutional investors become net sellers. You can see the percentage a DII has invested in a company by reading the company's annual report. When you compare FII to DII, there's a term called ownership ratio. Ownership ratio is the ratio between the total equity holdings of FII to DII. This ownership ratio gives us a brief idea on how the activity is going between the two. Currently, the ownership ratio is 1.2 and it's always greater than 1 because FIIs have significantly higher buying power. Another factor to look upon is the net buyers and sellers in India. This is updated every trading day. You can check out this in the NSE and BSE websites. If foreign institutional investors are net sellers, this means they are trying to sell more rather than buying. This can be a possible scenario of FIIs leaving the country. In India, there are 4 types of domestic institutional investors. A mutual fund is a financial fund made by collecting a pool of money from many investors and invest this money in stocks, bonds, and other financial assets. These funds are operated by professionals or money managers who allocate this capital to produce gains to the fund's investors. That's where the expense ratio comes. That's the money you are giving to the fund manager to manage that particular mutual fund. Insurance companies offer a range of insurance options right from retirement fund, life insurance, health insurance, term insurance, and so on. A popular one is the LIC policy you take, which is term insurance or life insurance. The LIC policies you take, all this money is pooled in together to have a massive cash contribution, and all this capital is invested in the stock market to get returns and gains to this capital. These companies are a large contributor to that overall DII equity and contribute in the range of 20,000 crore each quarter. The purpose of pension fund and pension scheme plans is for individuals to lead a hassle-free retirement by having a retirement corpus. Our Indian government has National Pension Scheme, Public Provident Fund, Employee Provident Fund organization that contribute to the nation's DII. Pension schemes is one of the biggest domestic institutional investors in equity holdings. Now you can imagine how your small contribution every month is getting into a big corpus after retirement. Banks and financial institutions are not a major contributor for the DII, but their asset under management, that's the money they are putting into the stock market, is continuously growing every quarter. The money which you put as fixed deposit in bank and the money which you pay as interest for the loans, all this money contribute to a large pool of cash in hand with the bank, and they invest this money in the stock market. The returns and the interest earned from the stock market is used to give back the interest for the fixed deposit you have deposited and for the expenses and growth of the bank.